So our next chapter is income statements for sole traders. Now this is a fairly easy topic, just preparation of an income statement. Now let's start with some definitions. Now who is a sole trader? A sole trader is the owner of a business who runs the business on its own. Income statement. Income statement is an account prepared periodically, that is, mostly annually, to find the profit or loss made by the business. Revenue or turnover is the total sales of goods or services made by a business. Cost of sales is the net cost of goods sold to the customers. Gross profit is the profit calculated by deducting the cost of sales from the net sales in the income statement. And net profit is the profit after deducting all the expenses from the gross profit. Now let's see how to prepare an income statement for a sole trader. The steps are: first, make sure all ledger accounts are balanced and a trial balance is prepared at the date to which the income statement is going to be prepared. Then, transfer the balances on the nominal, that is the revenue, income and expenses, to the trading account. Okay, and the next step is to ensure that the amount of closing inventory is accurate and any adjustments related to it is done, and then only move on to finding the gross profit. And the last step, prepare the rest of the income statement and find the net profit for the year or the profit for the year. Now let's see the format for the income statement. Now, as we know, income statement is divided into two parts, that is trading account section and the rest of the income statement, that is the profit and loss account. So now let's start with the trading account part. So it starts with revenue, then less sales returns, then you get the total revenue. Now, sorry to interrupt, but ignore these amounts and just go with the particulars part and the format. Then less cost of sales, this is the heading. Then cost of sales combines of opening inventory plus purchases, less purchase returns, then less goods for own use drawings. Now this is one thing that can come in adjustments, then add carriage inwards, then less closing inventory, that will all give you cost of sales. Then the revenue figure is to be deducted from the cost of sales, which will give you the gross profit for the year. This ends the trading section. Now starts the profit and loss account. Then add other income to the gross profit, contains discount received, rent or discount received. There will be various incomes that the question will give you in the trial balance. Then less expenses, some types of expenses are given here. Then total of all of this, that is the total expenses. Then total income, that is this, which has been added to the gross profit. So total income less total expenses, that will give you profit for the year. Now let's see some of the important pointers. Now a few important points to note while making this is for making the income statement. Remember to give proper headings. Include in the heading the name of the trader of the business and also state the period covered by the account. Now this is important, and in case you don't write it in your exam, then they may cut your marks. So definitely don't miss out this. It includes the name of the trader or business and the heading income statement for the year ended, and this will be the date. Usually it is 31st December 2000 whatever. Okay, Next, carriage inwards is taken as a part of cost of sales. Okay, this is important. In a hurry, you may miss out or write here and there, but it is very important that while marking in the trial balance at the start of the question, write it over there, carriage inwards, the next to it, that this will go in the trading account cost of sales and not as an expense. And carriage outwards is the cost of delivery to the customer, and so that is treated as an expense but not the cost inwards. Okay, next, this is also important. If there is drawings given in the question, then it should be deducted from the purchases at cost price and added to the trader's drawing account. Next, if the business is a service business, that is one which doesn't buy and sell goods, then there will be no cost of sales. You will only need to show the income, which will be the fees received less the expenses to reach the profit for the year. Next, a loss arises if the expenses exceeds the gross profit. Oh, there's a typing mistake. This is gross profit. Then, any type of wages mentioned in the question where the goods made may not be in a suitable condition for selling to the customers, that is, they may be semi-finished, then that amount, that wages amount given to such employees who have made such semi-finished goods, that should be added, that wages amount should be added or debited to the cost of sales in the trading account. But mind that this will be done only if the question specifies. Otherwise, in general, if there is no information, no additional information given, then the wages will always go in the profit and loss section, that is over here, less expenses. Now let's see the last small part, that is inventory. Inventory is of two types, opening and closing. Opening inventory, 1 year's closing is the next year's opening inventory. Easy. Now the opening inventory must be included in the cost of sales for that year in the trading account, as we saw in the format also. Now this is important. It is rare for them to ask, but it is still a possibility, so take a note of it. In the case the business is newly opened, which will be mentioned in the question specifically, so do not assume. So now in that case, there will be no opening inventory as it is the first year of production. Now let's see the closing inventory. Obviously, it is unlikely that the trader will be able to sell all of its goods in that year, which then will be sold in the next year, and these goods represent the closing inventory. Now this is an important part. It should always be at cost price only. This is very important, and it must be deducted from the cost of sales in the trading section of the income statement. Closing inventory is also a current asset. Now I have just summarized over here what cost of sales or cost of goods sold comprises of. So cost of sales or cost of goods sold comprises of opening inventory plus purchases less purchase returns plus any particular expense. This expense, as we saw previously, can be wages, but it is rare for them to give such additional information, and then less closing inventory. So it is basically just opening inventory plus purchases less closing inventory, but they may give additional information for purchase returns or any particular expense.